Hello, everybody, and welcome to Financial Fridays with Dawn. Today's topic, we're going to be talking about a highly controversial and often misunderstood topic, which is investment fees. What are you really paying? Most people have no clue. Some people don't even think that they're paying any fees, like such as if they're invested in their 401k, they don't think they're paying anything. But there are fees in that as well. Now, the most common thing is you'll hear what they call wrapped accounts and unwrapped accounts if you're working with someone who is a financial professional. Now, most people that work with wrapped accounts, this includes everything. There's just one fee. So this includes if there's any mutual funds, this includes the money manager fee, the custodian fee, the advisor fee, all the admin costs. It's all wrapped into one little fee, and there's no commissions. It's just a fee that you pay. Typically, these are about like 2.48 and down, depending on what type of assets you have, and this can be negotiated with your advisor if you have a sizable amount of assets. Now, typically what people see out there and what the media likes to talk about is the unwrapped accounts, where you'll see, like if you're with a major wirehouse, you're paying only 1.5%. But that is not the whole truth. That's just what you're paying the advisor. Inside of that, there's a whole bunch of other fees that are extra. Like I said, you're going to be paying commissions on top of that. You're going to be paying mutual fund fees, which I'll get to shortly. All the admin costs, trading costs, the custodian, like if it's a TD Ameritrade, everything has fees associated with it. So, but on your statement, you're not really going to see that. You're just going to see that fee that you're paying your advisor and think that's all I'm paying. So what I do is I actually do a whole blueprint analysis and show you, okay, this is what you're actually paying. And I also break down your portfolio. And what I've been finding lately is, for example, here I have one account. This is from a major wirehouse, one of my clients. And you could see there's a lot of yellow here and a lot of green. So you're like, what the hell does this mean? Well, in plain English, this means that this portfolio appears to be done by a robo-advisor because there's so much yellow. And what the yellow means is that it's very anti-correlated. So when something goes up, something else is going down. So for example, like the S&P 500 index and the S&P 500 index short, the short ETF is betting that the market's going to go down. So you're kind of going nowhere fast. So that's why this person came to me and said, I'm not making any money in my account. I'm losing money and I'm not really getting anywhere. So, and that's because this, again, is what they call a robo-advisor. So a computer is doing this. It's perfectly hedged, anti-correlated, and that's why the guy isn't making any money. So, and he's paying an advisor a fee to sit and manage this, which there is no management. Now, here's another example of another portfolio. Again, this is another major wirehouse, and you can see there's no yellow, but and there's a lot of red with a little bit of green, but there's no yellow. So this one it's great in an up market because now when everything goes up, you'll go up. But when you go down, there is no protection. This thing is going to lose a lot of money. Now here's what a portfolio should actually look like. Bear with me one second here. This is what a nice portfolio should look like. Lots of green, a little bit of red, and some yellow. So what this means is you're not taking on a lot of risk and you're getting all the reward. And we have it diversified so that, yeah, if some things go up, some things go down, but not everything. So this is kind of what you want to have. And then also these reports break down the fees. So I'd be more than happy to help you guys if you want me to examine your portfolio. First, what I do is I get your risk score. So if you go to my website, dsfinancialstrategies.com, there's a little button on the side. It says take a free risk assessment or my risk quiz, what's your risk number. Click on that. It's going to ask you some questions. It's going to measure your emotional risk tolerance. Because as we know, when it's a great market, everyone's feeling aggressive. But when you say, okay, well, if you lost half of your portfolio, how are you going to feel? It makes it kind of real. So it's like your actual money. So it'll come up with a perfect score for you. And then I'll take that score, look at your current portfolio and show you where you are in stance to that and how much fees that you're actually paying. Because you might be one of the many people that believe they're only paying like 1.5%. And also what I do at my portfolios is we actively manage them. So like, for example, a couple weeks ago, we used Alpha, Signix, and Omega they use along economic trends to decide when we're going to move the portfolios, because you don't want to just use a computer portfolio like a robo-advisor, because back in February, like as I showed you with that yellow, all that yellow on that guy's portfolio, what happens, he had like triple leveraged ETFs, and that's why the market crashed, because ETFs, they had to sell out because they were doing inverse, so they couldn't handle it, and that's why we had that day it dropped like 10%. So again, that's why it's important to work with an advisor and not just a computer. So getting back to our indicators, the alpha and omega, so just turned, well, one turned negative in February, like I said, and now the other one, omega, turned negative on June 25th. So then when that happens, what we do is we make our portfolios more conservative. For example, we have our ultra growth, which was 100% equities, is now only 75% equities and 25% is in cash. So that's why you don't want to just depend on a computer. You want real knowledge. You want an advisor, someone who's looking at your portfolio, not paying someone to do all this work, and it's just a computer doing it for you. So that's about the fees on your investments. Now there's other fees too, like for, let's say you have an annuity. Depending on the type of annuity that you have, you could be paying a lot of fees. Like for example, a variable annuity, you're paying not only the insurance costs, you're paying for the investments, they have costs as well, any rider fees. So typically, you're going to pay like 2 to 5% to have a variable annuity, which is why they're not really used popular today, unless you're with like a broker dealer, because they push that and you get high commissions. There is another product called a fixed index annuity, which they really don't have any fees. They might have a spread. If there's an income rider, you may get charged for that, but they are a lot lower, anywhere from like 0.95 for that income rider, or a spread could be like as high as 1.75, still nowhere near what you're paying. And a way to look at it as a fixed index annuity is basically kind of like the bond portion of your portfolio. That's why I don't really like variable annuities, because basically those are investments, so you want to try to get a high rate of return with those, but you're kind of stuck because you're paying all those excess fees when you should just go invest in the market if you want that. And then there's an annuity that's totally free, and that's just a fixed annuity where you get a certain rate for like 5 years. They're not doing so well in our low interest rate environment. For example, a 5-year annuity now is paying about 3%. So that's what the fees are when you're talking about annuities. And then there's also mutual funds. So there's different types of classes. The most popular classes that individual investors are going to see are A shares, B shares, and C shares. So I'm not going to go into all the details, but basically an A share, you're paying an upfront charge of about 5.75%. And then you have what they call 12B1 fees, and let's just call those like admin fees that you have to pay. And if you have what they call certain levels of investments, like certain breakpoints, you'll get a discount on that. Now, B shares typically have the highest internal cost, and there's no fee to get in, but there could be a back-end charge to get out if you take them out before 7 years. And then finally, there's what they call C shares. There's no front load, meaning you don't have to pay to get in them. Typically, it's about 1% that you're paying every single year for that. And if you hold it more than a year, there's nothing to get out of it. So like if you're doing a lot of trades, people might use those. So that's kind of it on investment fees here. And then here's also questions that you want to ask when you're interviewing your potential financial professional that you want to work with. You want to find out, okay, what is the all-in cost for investing, not just their fee. Ask them to give you a blueprint and show you, okay, what is the actual breakdown and what do they charge for their commissions. Also, what's the discipline that they use when they're managing your portfolio? Do they even have a discipline? And they should be able to clearly tell you why they're putting you in certain investments and why you're going to own them, what the benefit is for you. And speaking of that too, going back again to that portfolio, that first one I showed you, that was an IRA account. And basically, this guy was kind of like day trading with his robo-advisor in there, and for a long-term investment, which totally not a good strategy. If you had a separate account that wasn't an IRA, like then you could kind of do that. It just didn't make sense to have it in that type of account. And also, they have to have like a quantifiable risk management system. And what happens when the market goes down? You want to make sure there's something in place, like how we actually actively monitor our portfolios, look at all the indicators, and then also use human brain power because we don't want any computer glitches. And look and manage a portfolio. So we use everything, economic trends, pricing. So you look at everything as a whole. And also you want to be comfortable with your actual risk tolerance. Like, say, typically most young people should be aggressive. Now that's like way too broad to say, because there could be young people that are conservative. There could be older people who are a little more aggressive. So it doesn't, I don't believe in that philosophy. Everybody is an individual, so you have to look at their individual and their individual risk tolerance. Well, that's all I have for you today. I hope this was helpful. Like I always say, if you have any other topics that you want to know about concerning your money, please feel free to message me. Also, take a look at my website, dsfinancialstrategies.com, and that's where you'll find the free risk assessment as I spoke about earlier. If you need to reach me, my number is 215-660-0288. And also, my little disclaimer, I am an investment advisor representative of Caitlin John Private Wealth Management, which has no affiliation with DS Financial Strategies. Well, I hope you enjoy your weekend, and I will come to you next Friday. Have a great day.